I'm glad you called, Ann, because it brings up a point that I talk about with these insurance products. I like long-term care insurance. I don't have issues with it. But one of the issues that I do have is the way it's, I don't know if you can say the way it's sold or the way that it's purchased. And oftentimes we don't have a long enough, we don't have a short enough elimination period. We don't have riders that make sure that it pays for in-house care, and they're all subject to ADLs. So there's 5 ADLs. An ADL is an activity of daily living. So these are things, and you already talked about those. These are things that there are 5 things that everybody does on a regular basis. So when you can't do a certain amount of those, 2 or 3, whatever it is, you have to be unable to do these things before it pays out. So basically, long-term care insurance is designed for skilled nursing facilities. Some of them are designed for stay-at-home care, where the ADLs may only be 2 required, any 2 that you can't do, which is a little better for stay-at-home. So some of those may be required for that. But, here's the thing. You've paid into this for a long, long time. If you've paid into these for a long time, I would say to you, find out if your premiums can go up. Have you had increases on your monthly premiums?
It started out as 147,
okay,
and it's like 162 now.
Okay. So why don't you find out what you're going to get back if you were to get out? But if you got the policy based on the fact that you're concerned as to what you might do. Now, here's what I would say to you: if you don't have a lot of resources, then even with long-term care insurance, should you go into a nursing, facility of some sort someday, chances are you're going to still need, you're going to spend down what resources you have anyway, because the long-term care insurance isn't going to pay for the entire daily benefit. Might not even, by the time you would get there, you're still in good health. It could be years from now. It may not even be 30 or 40%, which means you have to use your other resources, and they're going to be gone, which means you're going to end up on some sort of Medicaid, supplement anyway to supplement your care. So in that case, it's probably not necessary. If you have a whole lot of money, obviously you don't have to worry about it, because your income from the money that generates will cover your care. So I think you look at those kinds of things. $165 a month, if you're on a fixed income, is a lot of money, and I certainly would understand. And if your rates have already gone up, when you turn 75, I'm just making up a number, it might be 72 or whatever, but they're going to go up again. And as you get older, irregardless of how healthy you are, they're going to continue to go up. And every time they go up, they're going to go up a lot more from a percentage standpoint than they went up last time. So I think if you just examine some of those issues, in your heart, whether, where you are in that scenario, I think you'll probably find that it would probably be okay to get, to let it go.